Welcome to our webinar series focused on professional services firms. For those who don't know me yet, I'm Anna Jarrold. I'm a tax partner and I focus on advising professional services firms as well as the two speakers that we've got today, Jachendra Patel and Louis Keeping. So again, for those who don't know BDO, we're a network firm. We've got over 10 billion US dollars of revenues, and we have over 90,000 people working for BDO across the globe in 167 countries. So most of our clients are now becoming international or already well and truly international. So we've got a broad spectrum of advisors who focus on professional services firms across the board. So as I mentioned, both our speakers today are from the professional services tax team in London. We've got Jachendra Patel, who is a director, and Jachendra focuses on all sorts of professional services firms as clients, advising both the entities and the individuals on tax matters, whether there's partners or the executives of the corporates involved. Jachendra actually is also sits on the Chartered Institute of Taxation Owner Managed Business Technical Committee, which gives him some real good insights into what's going on at HMRC. And prior to that was at HMRC himself, advising on policy matters and also on legislation, whether that for partnerships or for corporates. So moving on to Louis. So Louis is an associate director in the team and has been absolutely central to organising these seminars. So we wouldn't be doing this without Louis. So thank you very much, Louis. Again, broadening, advising on a broad spectrum of clients in the professional services sector. So you've got some real specialists here today. Right, so what are we going to be covering today? So we're mainly focusing on UK tax today. So what's happened in budget day and also on the tax day. So all of those updates and how it will really affect professional services firms going forward. We've also got some time at the end, as always, for questions if you'd like to pop those into the Q&A box on your screen. If we've got time, we'll pick them up. If not, we'll pick them up with you personally after the webinar. So without further ado, I will hand over to Jachendra. So Jachendra, over to you.
Hi, thank you for that introduction, Anna. And hopefully that reference to my HMRC background hasn't turned off our audience today. But I'm delighted to be talking to you all today. So as Anna mentioned, I'm going to be talking you through the announcements that the Chancellor Rishi Sunak delivered in his budget last month on the 3rd of March. Next slide, please, Jade. As probably most people expected, and completely unsurprisingly, and absolutely in line with everything that happened in the 12 months before, COVID-19 absolutely continues to dominate the agenda. The Chancellor talked about the acute impacts on the economy and the public finances, making it very clear that he felt he had to be honest with the public about those things. And then he talked about his and the government's three-part plan, that being protect jobs and livelihoods. And the phrase "do whatever it takes" came up a number of times within that. And then he talks about the plan involving fixing the public finances and fixing the economy going forward through an investment-led recovery. So what I've done today is picked out some of the key points from those announcements, particularly those that are relevant to our professional services audience. And I'm going to talk you through that now. Next slide, please, Jade. Okay, as mentioned, there has been huge damage to the economy as a result of the coronavirus over the last year or so. Stark message at the top there, which is 700,000 people have lost their jobs as a result of coronavirus. And the economy has shrunk by 10%. Now, apparently that's the biggest dip that's been seen in over 300 years. So repairing the long-term damage is obviously going to take a lot of time. The Office of Budget Responsibility, the OBR, the very bleak picture in autumn 2020 about the impact on the economy and how long it would take to move forward. There was slightly more positive news when the March budget was delivered. They're now expecting a swifter and more sustained recovery than they'd previously expected. In part, that's probably due to the success of the vaccination program in the UK. I think at the time of the budget announcement, about 20 million people had been vaccinated with their first jabs. I think the figures are actually closer to 40 million now, so we seem to be doing very well on that front. So hopefully that's good news. The LBR said they expect the economy to be back to pre-COVID levels by the middle of next year. But the news is that that's still expected to be 3% smaller by 2026 than it would have been if we hadn't had the pandemic. So that's still a shock to the system. The cost of doing whatever it takes has had a huge impact on the borrowings that the government has had to incur. Some truly eye-watering amounts of money expended and record levels since World War II seen. So in 2020-21, they had to borrow 355 billion. And in the year 2021 to 22, the expected borrowing is projected to be 234 billion. So absolutely huge amounts there. The debt levels are expected to peak at 97.1% of GDP in 23 to 24 before stabilising. But the message was very clear from Mr. Sunak that it's going to take decades to pay back. So it's going to be this government and future governments as well having to deal with the impact of COVID for a long time yet. Next slide, please, Jade. So we talked about doing whatever it takes. So I thought I'd pick out some of the support measures that Mr. Sunak talked about on the day. The first one probably people will be familiar with, the Coronavirus Job Support Scheme, which is also known as the furlough scheme. I have to admit, furlough is a word I wasn't familiar with until just over a year ago, but it seems to be on everyone's lips at the moment. The scheme has been extended to September 2021. For employees, it's going to work in the same way. So they'll continue to receive 80% of their salary for hours not worked, up to a cap of £2,500 per month. It's slightly different for employers because of the restrictions are expected to be lifted by the end of June. Then employers will be expected to contribute 10% in July and 20% in August and September. But just wanted to flag there that it's important to make sure that claims are made accurately if anyone is making furlough claims, because we know that HMRC are looking into the claims.
Yeah, and actually, just Chandra, before you move on that, how do we know they're checking? What are they actually doing at the moment?
So we've seen some high-profile stories in the news. We know that they've been focusing on what they perceive as fraudulent claims, and we've seen some prosecutions going forward where people have been, very naughty actually, and committed fraud in those areas. But probably what we're expecting is more routine compliance checks, so not necessarily fraudulent activity, but just people getting it wrong and checking those figures. What we've seen as a recent development as well is that the corporation tax returns and partnership tax returns now include boxes for people to declare how much they've claimed. But the interesting thing, there's also a box to declare any incorrect claims. So what that's doing is it's giving responsibility for the person signing the return, so the director of a company or a nominated partner in a partnership, to actually say, yes, the claims we have made are accurate. And we'd expect, or at least it's prudent to expect that there'll be some policing of that at some point. So very important to check that they're accurate and also to keep records to support those claims.
Yeah, and reputational risk is all part of this, isn't it? Not just getting it wrong, but reputation around this as well.
Absolutely, yeah. And just a couple of other points that might be relevant for professional services businesses. So the Chancellor announced that there'd be a doubling of the incentives for hiring apprentices between 1st of April 21 and 30th of September 21. So the usual amount is 1,500, and that's going to be doubled to 3,000. So I believe it applies to apprentices of any age, but it would, I guess it's something that they're hoping will help young people to get into fulfilling careers effectively. And the other point I wanted to mention was that there is a recovery loan scheme open until 31st December 2021. This is apparently available for businesses of any size and any sector if they have been adversely impacted by COVID. And the idea is that they can borrow up to £10 million from participating lenders. The loans will be for up to 6 years. And the government have said that they will guarantee 80% of that finance to the lender. Next slide, please, Jade. Okay, so now I want you to talk through the bit that us tax advisors get most excited about, which is the tax headlines from the budget. Starting with personal tax, there's been no increase in the rates of income taxes, but what the Chancellor did announce that the personal allowance would be frozen at 12,570, and the higher rate threshold would be frozen at 50,270, and that would apply until April 2026. So this is a concept known as fiscal drag, and it's expected that this will bring lots of people who currently don't pay tax because they're within the personal allowance into the tax-paying net. And also a lot of people who are currently basic rate taxpayers are expected to move into those higher rate tax bands over the next 5 years. So it's a way of not increasing tax rates, but the idea is that it will still bring in a significant amount of tax. The other similar announcement was around capital gains, and there was an announcement that the annual exemption will be frozen at 12,300 again until April 2026. Louis is going to talk a little bit later about what we might have been expecting in the capital gains arena on that as well. But the announcement as it stands is that the annual exemption is frozen, but nothing else has been announced to date. So moving on to corporation tax. So this wasn't completely unexpected. I think we heard a lot of rumours about it before the budget day announcement, but I'd say it was still the biggest news in the budget, and that's that the corporation tax rate will increase to 25% from 1st of April 2023. So that's from 19%, which is the current rate. And the way this will work is that companies with profits exceeding 250,000 will be taxed at 25%. Companies with profits up to 50,000 will benefit from a small profits rate, which is the 19% as it currently stands. And where businesses have profits in between 50 and 250,000, there'll be a tapered rate that applies. So it'll be somewhere in between the 19 and the 25. A point to mention is that those thresholds are subject to what we call associate companies, people who remember the old rules around associated companies, may be familiar with those, but an associated company is effectively companies under common control by the same person. So what we do is we have to factor those in, and that will reduce those thresholds at which you get into the higher band of tax.
And did we not have this? Did we not have this system before? This feels like a sort of a rewrite of what we used to.
Absolutely, Anna. Yeah, it is similar. And I know when I started working in tax, there was two rates at the time. So there was a main rate of corporation tax, which was 30% at the time, and a small profits rate, which was 19%. So it does feel like we're almost going back there. Now, over the years, those bands got closer together. I think I remember in 2014 they were only 1% apart, and then from 2015 we had a flat rate applied. It was 20%, and then it was reduced after that. For me personally, I enjoy the simplicity of a single rate. I can see the political reasons why they wanted to keep a small profits rate for those businesses that aren't doing as well. But it is a bit of a shame that we've gone back to the old complexity rather than the simplicity of a single rate. A point to mention as well is that the Chancellor was very keen to mention that even on the increase to 25%, the corporation tax rate is still expected to be the lowest in the group of G7 countries. So that was a relevant point as well. And just a final headline there, which I'm going to cover a bit more later, was around the capital allowances super deduction, which was fairly surprising news, but I'm going to come on to that. Next slide, please, Jade. So I just wanted to talk about how that increase in corporation tax might affect a choice of structure for professional services firms. Professional services firms typically use either an LLP or a limited company structure. In terms of an LLP, it's what we call tax transparent. So there's no tax payable at the entity level. However, the profits are treated as rising directly to the partners. And those individuals are taxed at rates of up to 47%, factoring income tax and national insurance. A company is different. It's not a transparent entity, so it pays tax itself. So if we factor in the corporation tax, which will be payable at 25%, if the company then distributes its post-tax profits out as dividends, the individual shareholders can get taxed at up to 38.1% on those dividends. So this is a very simplified example. We're not factoring all the different rate bands and such and allowances. But if we assume there's a full extraction basis, so all of those profits that are earned by the company are paid out to the shareholders, we actually get up to an effective rate of up to 53.5%. So that's now, seems very high. So it's one of those things where tax is a factor that people will think about when they're deciding what structure to have, or if they've got a structure, should we have a different structure? It's not the only factor, obviously, but that might influence what people think about the comparison between an LLP and a company, and we may have conversations with people about that. As I mentioned, there's lots of other factors to consider. In a company, there is that ability to defer making the payments out to the shareholders. So we have the tax at the 25%, but there's not necessarily a further tax charge until something else happens. There's also a possibility that any money that doesn't have to be paid out to shareholders can be retained and possibly extracted at a later date and benefited from capital gains tax rates, which are 10% or 20%.
Yeah, and I suppose I know we'll come on to talk about it, but there's the capital allowances and lots of other factors, as you say. And
That's
so
right.
I know there's some uncertainty about the future on tax, but are we starting to see people talk more about changing structure? And if so, is there a particular trends that we're starting to see now?
Yeah, I think so, and I think traditionally we've had law firms and accounting firms were always structured as partnerships in the old days, and when the LLPs came in the early 2000s, lots moved to the LLP model, and then when I think other businesses in particularly in professional services sectors or people businesses saw how an LLP could be a successful operating vehicle. Then we saw lots of other types of businesses move into LLP structures as well. So they may have started as new businesses with an LLP, or they may have had a previous limited company structure and moved that into an LLP structure. I think what we've seen more recently is, and perhaps partly because of complexity of partnership rules over the last few years, particularly where there's mixed structures involved, we've seen lots of people thinking about, actually, is it more simple for us to move into the company structure? Other reasons, and we've worked with clients on this, are potentially where clients are looking at the potential for a sale or a listing, and sometimes if that sort of transaction is expected, then they may prefer a corporate structure as opposed to an LLP. We do see investments coming directly into LLPs as well, but I think limited companies, people often talk about them being better understood. So we've definitely worked with clients with LLP structures and looking at incorporating those in recent years.
Yeah, and then we've got the issue about transfer of ownership, haven't we? Depending on the structure that we've got. So we could probably have a whole session on this. So I'll stop asking questions.
We could. Okay, next slide, please, Jade. Okay, and this will be relevant for any businesses that have an LLP with a service company structure. It's quite common in professional services. So what we have there is our LLP is our main trading entity, but the service company holds all the employment contracts with staff and incurs the employment costs and other overheads. Those effectively, the company provides services to the LLP, charged at a cost plus the markup, and typically we might see maybe a 5% markup applied, which is usually acceptable. So the point I wanted to mention here is that now that we have this increase in corporation tax coming, then if those profits made at the service company level are going to be distributed out to the LLP, then we've got an increase in the effective rate suffered, because any dividends paid from the service company to the LLP are treated as being made directly to the individual members. So we can get up to a rate of 53.5%, as I just talked about. So then there's a question about, if the service company makes profits, how else, can those profits be used? There's issues around if the service company lends the money to the LLP, we have what we call Section 455 tax can kick in, and that's a charge on the company at a rate of 32.5% of the loan. That is a repayable amount, but the LLP would need to repay the loan to the service company in order to get the money back from HMRC. Other things possibly is we see is where the LLP has other shareholdings in other companies, then there may be a corporate group structure sitting underneath the LLP. And if there are expected to be some loss-making entities, particularly sort of startup operations and such, then that might be beneficial to keep that type of structure in order to offset losses and profits. And similarly, any money retained at the service company can be potentially used for investment sort of downstream rather than being paid up to the LLP and getting taxed at the individual shareholder level. So something worth thinking about anyway, if you do have that structure, really thinking about, is this still the right structure, and should we think about changing things? Next slide, please, Jade. Okay, I mentioned briefly that one of the other big headlines from Budget Day was the super deduction. And probably the biggest surprise, the rabbit in the hat, traditionally, that the Chancellor likes to pull out. This is a temporary capital allowances first year allowance, effectively. So companies that incur qualifying expenditure between 1st of April 2021 and 31st of March 2023 are eligible. And where the assets acquired are what we call main pool items, so most plant and machinery will qualify for 130% first year allowance. So that's why it's called a super deduction, because actually you're getting full relief for 100% of the expenditure and 30% on top as well. And that's in the year of acquisition. There's also a first year allowance for special rate items. So typically these are assets classed as integral features. So air conditioning systems and such. And for those types of assets, there'll be a 50% first year allowance. So you get 50% deduction in the first year. There are some exclusions. So cars, which government tends not to like to give too much relief on cars, so they're always excluded by these things. Second-hand assets, because the idea is that they want people to invest in new assets, and assets held for leasing as well. So that might kick in where people incur expenditure on property that is going to be let, so that those types of assets won't qualify for the super deductions. So this is a very generous scheme where the 130% super deduction applies. It'd be tax relief of £24.70 for every £100 spent. There's no cap as well, so it's an unlimited amount of investment that can qualify. And the other thing to mention as well is that it can be claimed in addition to the annual investment allowance. So it's not one or the other. You can actually claim both. So a very generous scheme. But one thing to watch out for is that all of the expenditure will need to be tracked, because the rules say that balancing charges will apply if there are disposals, and there's some complicated rules around that depending on whether the assets are disposed of before the change on 31st of March 2023 or after. So it's something to be careful of, but the point to be aware of is any expenditure will need to be carefully monitored, and all the way up to the point of any disposal of those assets on which either the super deduction or the 50% allowance has been claimed.
Yeah, that's a really good point, Chandra. I think practical points like that are always helpful before the expenditure has been incurred, or at least early on. You mentioned companies in all of this. What about partnerships? How do they feature in the super deduction?
Unfortunately, they don't, Anna. So the government has introduced this relief for companies, but it doesn't apply to partnerships, and that includes partnerships with corporate members as well. I've had some questions about that, and unfortunately, the answer is no. It seems very much that this is to soften the blow of the increase in corporation tax. It seems very much linked to that as a policy rationale. I think the government may have also been concerned that people may defer investment until the higher rate of corporation tax kicks in order to benefit from having a deduction when the tax rates are higher effectively. So it sounds like this is something that they've very much thought about introducing for companies, but limiting it to companies only, which is a shame, I think, in terms of the policy. If the government wants to encourage people to go out and spend money on assets, it would have been a good idea to include partnerships within this, but I think representations have been made to government, but we're not seeing any change, and not expecting any change, unfortunately.
Yeah, it's certainly something I know we've brought up. So yeah, okay, great, thank you.
Thank you. Next slide, please. Okay, so this is, again, it's another measure that's designed to soften the blow for companies that have going to have an increase in corporation tax, but also those that have suffered as a result of the coronavirus pandemic and may have had losses when previously they've been profitable. So the normal rules around trading loss carryback, so that you can use any losses against profits of a previous year, but for a temporary period, there'll be an extension to 3 years. So for companies, it will apply for losses incurred in the periods ending between 1st of April 2020 and 31st of March 2022. You have to use those losses against the most recent years first. In terms of the previous year, there's no changes to how much you can use, so it's unlimited. But if you want to go back to -2 and -3 years, it's subject to a 2 million cap. The claim has to be made in a corporation tax return if it exceeds 200,000. Otherwise, you can make a claim outside, and that might be helpful if you want to accelerate the timing of getting that relief and getting a tax repayment effectively. An interesting point is that for groups, the cap operates at a group level. But the quirk in this is that if all of the company claims individually are below the 200,000 de minimis limit, there's no cap applied. So actually, collectively across the group, you can have more than 2 million. But as long as each individual claim is less than 200,000, that's fine. If one or more is more than 200,000, then the 2 million cap applies. And just wanted to mention unincorporated businesses as well, which will be interesting for our partnership clients. So similar rules, so 2020 and 2020-21 and 2021-22. Losses incurred in those years can be carried back again to 3 years. Similar rules will apply about the cap, but the interesting thing is the cap is not applied at the partnership level, so it's on an individual level, so less likely to kick in. And also that standalone claims can be made as soon as the basis period in which the loss is incurred has ended and the loss has been calculated. So it doesn't have to be made in a return. Next slide, please, Jade. Okay, I just want to have a quick canter through some of the other tax announcements which may be of interest as well. I mentioned annual investment allowance earlier. It was announced that this will be maintained at 1 million until 31st December 2021. It had been due to revert back to 200,000, but that has been maintained. Again, it'll be interesting what happens after 31st December 2021, whether that will then revert to 200,000 or will it be retained at that 1 million level. And as I mentioned, it can be claimed in addition to the super deduction that we talked about as well. So there'll be some thinking around how to maximize the value of claims needed. Another point just to mention around the corporation tax changes, and I mentioned the associated companies rules coming back effectively, so being reintroduced. And a point to be aware of that this is also relevant for quarterly installment payment requirements as well. So you may find situations where actually the requirement for quarterly installment payments kicks in as a result of the associated companies rules applying. And particularly where I see that applying would be where there are companies which are held under common ownership, but not necessarily under a corporate group structure. So we could have that situation, particularly where we've got partnerships having partners holding companies directly. We quite often see that. Another point to mention is this is something that happens as a result of Brexit. So the EU Interest and Royalties Directive has been repealed from UK law, and that's effective from 1st of June 2021. And what that means is any payments to associated EU companies may now be subject to UK withholding tax. So we'll need to check the double tax treaties to check whether there's a withholding tax exemption or whether a reduced rate applies. But it is something definitely to be aware of. And then final point there, just to mention, I'm sure people have heard about it lots by now, but just a reminder that the off-payroll working rules did come into force on the 1st of April 2021. So if anyone still needs to do some thinking around that, it's definitely a good time to be doing that.
Yeah, it's amazing how much of a flurry of activity there is towards a deadline, that is for sure. And given we're past it now, hopefully most people have got themselves into position. That's brilliant, Jitendra. Thank you very much. So that's what was covered off in Budget Day. Now let's move to talk about what's happened in the tax day. And obviously there's a lot of questions being raised through all of these consultations. So over to you, Louis.
Thank you. So 23rd of March, not only my birthday, it was also the bonus of tax day. So the government published a range of consultations and reviews. I think as generally was expected, the primary focus was on the modernisation of the tax system, boosting the compliance, as well as streamlining the tax payments. There was little information on future policy direction and more high-profile areas such as online sales taxes, taxation of work, as well as wealth, and interestingly, environmental taxes weren't covered. But today I'm going to discuss the main tax day announcements that affect professional services firms, and in particular the following, which is the government's wholesale redesign of UK tax administration, the transfer pricing documentation, and also the launch of a second consultation on the notification requirements for uncertain tax treatments. It should be noted that in addition to the key announcements noted above that I'm going to cover, there were a number of other points of note in the government's tax day, which you may also want to consider.
And Louis, are you going to pick up those points here or later?
I guess just at a high level, because I was going to spend my time on those other 3 points I've mentioned. I think kind of there are announcements that around property taxes, so that includes your structural and building allowances and business rates, off payroll working, and VAT grouping and partial exemption. So perhaps spend a bit of time reading around those, but given time restrictions today, I won't cover those at the moment. So next slide, please, Jade. So as part of tax day on 23rd of March, the government issued a range of documents which focused on the admin of UK taxes. Most importantly, it included a call for evidence in relation to a root and branch redesign of the UK tax admin system. So in doing so, the government's making it clear that the fundamental reform and modernisation of the admin system is required, alongside increasing digitisation, which we've seen more recently anyway, with a plan to deliver a trusted modern tax admin system, which is supposed to be simpler, easier to navigate, and more responsive to taxpayers' needs. So we have to watch this space, I think. So other related announcements included a call for evidence on potential changes to the timing of payments for income tax and corporation taxpayers, and a request for consultation on forcing all UK tax advisors to take out insurance to protect consumers. So the government's call for evidence in relation to reforming the admin of UK taxes is pretty wide-ranging and quite ambitious, I think. It signals the likelihood of radical changes in the way that individuals, businesses, tax advisors, and others are going to experience the tax system in the future. So the review covers the whole of the UK tax admin system. So as I mentioned, it is quite wide-ranging. So it includes when and how individuals and businesses are identified and registered with HMRC, how tax liability is assessed, calculated, and paid, the steps that HMRC can take to check tax returns and claims, and the key elements of the dispute in tax dispute resolutions, I guess. So the scope of the call for evidence doesn't include underlying policy decisions. Custom duty administration is going to be reviewed towards the end of the process, but all other taxes and duties are included. The benefits and credits admin is not included in the review, but impacts on that area I think are going to be considered once the likely reforms to the tax system are actually determined.
Yeah, and Louis, evidence around all of these things is always so important to people because they always get, when the past is the past, they need to then find the evidence of what's required.
Yes.
So what might be included in all of this?
I think kind of from what's been read in the narratives, I think it's the government seeking evidence across quite a wide range of questions. I think including what should be the priority areas for reform, what else might be brought into scope, and what principles should guide the review. How might the computation of income and profits be changed? What should a modern tax return look like? And how might data be collected and used? Do HMRC's enforcement powers and associated safeguards for taxpayers perhaps need to be changed, encouraging better compliance to deter avoidance and evasions? I think especially in the context of the more digital world, as well as a more real-time tax admin environment. I think responses to the call for evidence are required no later than the 13th of July this year, and the government's committed to further consultation, I think, when any specific proposals for reforms are made.
Yeah, and I mean, all these things are so complex to actually make happen. So let's see what ends up coming out in terms of the computation of the income and the profits. And, you know, we're moving into a modern world. Well, let's see how quickly that we can shift into that new world.
Yes, it'll be interesting to see what they think a modern tax return looks like. So I'll have to watch this space, I think, on that one. Yeah. I think kind of finally a separate but very much related call for evidence has also been issued in respect of the reforms to the timings of tax payments for income tax and corporation tax, as I mentioned before. I think those individuals in receipt of income not covered by PAYE and NIC deductions and companies who aren't currently paying quarterly. I think also it should be noted that the future reforms could affect those who use personal service companies who continue to get targeted, I think. So I think the consultation is going to interest professional services businesses who engage contingent labour, who might be required to provide information to support the real-time calculation and payment of taxes on that front. And the government's objective here is, I think, to bring the calculation and payment of tax closer to the point in time where income and profits are made. I think we've seen that across Europe and other countries certainly doing the same. France, for example, are doing this. And it raises a potential number of complexities, including how income and profits are to be estimated in real time in order to drive the calculation of taxes due. I think there's clear linkages with HMRC's MTD programme, which is already being implemented for VAT. And again, response is required no later than the 13th of July. And again, the government will consult at that point on any proposed reforms. So quite a few changes ahead, I think, and interesting to watch to see what happens. Next slide, please, Jade. So I want to spend a bit of time covering next the proposal on the new transfer pricing documentation rules and the new annual tax return schedule, which covers related party transactions.
Yeah, and Louis, I know you're going to cover this, but as noted, the UK don't tend to prescribe the transfer pricing specifics around what should be in the documentation. Is this what this is really getting at?
Yeah, I think you're probably right. I think the UK is out of kilter with its peers in this respect. I think the other countries quickly mandated the OECD's Action 13, which is the master file, local file, country by country reporting. Whereas the UK only enforced country by country reporting. So I think otherwise I think it's probably thought that the general rules and record keeping should cover the TP documentation adequately. But I think the thinking is now changing. So HMRC are consulting on requiring large groups with UK operations to maintain specific TP documentation and supporting evidence broadly in line with those OECD recommendations. Along with that, I think they're also proposing an international dealing schedule, which is going to accompany the annual tax returns. So if this is enacted, I think the proposals would complement the other efforts made by HMRC, where they're trying to increase and improve the information they receive, and perhaps better target their inquiries.
Yeah, much easier to do their reviews. But I suppose it looks like we are waving goodbye to some of the flexibility that we've enjoyed up to this point.
Yeah, I think you're right. So I think the flexible approach we had has kind of limited the compliance burden that was faced by UK taxpayers. But I think since the OECD has published the final Action 13 in 2015, HMRC seems to have been a bit more concerned that UK businesses are pretty uncertain about their TP compliance obligations. And I think that lack of certainty is leading to inconsistent approaches, which they're trying to rectify. Interestingly, I think the 6 billion in additional tax that's arisen from TP compliance activities over this 5-year period and the perceived success of the profit diversion compliance facilities kind of brought into focus how important it is and the speed and efficiency of intervention, I think, in transfer pricing compliance. It's obviously quite a big pot of money.
Yeah.
So I think kind of the new proposals appear to have been informed by HMRC's recent experience, as well as kind of collaborating with the other tax authorities, as I mentioned before, the majority of which kind of took a wider approach from the OECD's previous actions. And I think the feedback from the other authorities has improved the TP risk assessment and compliance of the standard documentation. I think it's really helped those businesses and what they need to report. And as we discussed, a number of jurisdictions seen as comparable to the UK, where taxpayers must file a schedule of related party cross-border transactions, and the pricing applied is usually within the annual tax return. So I think that's kind of leading to HMRC's proposed introduction of a new international dealing schedule, where all businesses within the scope of the UK TP rules will need to set out details of their cross-border related party transactions. But again, a reminder that UK to UK transactions are, of course, excluded from this. I think the government's also looking to explore materiality thresholds based on size or tax risk, and the scope for aggregating the numerous amounts of similar transactions. It could be quite an admin heavy activity for companies to look at. But even so, I think this looks like a major new requirement for non-SMEs with international dealings. And again, it's of course another major acceleration of HMRC's access to TP-related data. And it's likely, as I touched upon, to pose some pretty major data collection challenges for some businesses with high volumes of intergroup transactions. I think it's going to be difficult to implement a system and maintain records that might be needed to be provided to the relevant authorities. So I think more is expected in the proposal that all large multinational groups, which effectively means those companies subject to the UK's country-by-country reporting rules, should maintain a master file and local file, which is broadly in accordance with Action 13. And I think the assumption, again, this is to be tested within the consultation, is that most affected groups will already be producing a master file, which is needed to meet other countries' requirements. So any additional compliance burden is really only expected to arise from meeting the local filing requirement. And I think also following from this assumption is a proposal for a 30-day limit to provide the documentation to HMRC on request, so quite a small turnaround time. But I think the trade-off for these businesses is a commitment from HMRC to engage early in order to ensure faster resolution of issues, so we'll have to wait and see. I think it should also be noted that speed's not the only objective. Also, I think HMRC are targeting the factual accuracy of the TP documentation. I think the consultation is proposing that the local file, and that's not the master file, should be supported by an evidence log which sets out the key sources of evidence, when they're obtained, and how they're being used in the TP analysis. And this might include, for example, notes of functional interviews, copies of legal agreements, system downloads of reports, that kind of thing. I think is what HMRC will be after. Next slide, please, Jade. Right, so moving on, I think as expected, the tax day saw the publication of a second consultation on notification of uncertain tax treatments by large businesses. So again, I think this is a really good example of why businesses should engage with consultations. I think it's pretty clear that the government's acted on the feedback which it received as part of the first consultation. So it's useful for firms to engage with HMRC. So a 12-month delay in implementing the requirements has already been announced, and these revised proposals set out in the second consultation kind of involve substantial changes to pretty much all of the aspects of the original proposals.
Yeah, so Louis, out of all of that, what would you pull out as being of particular interest to, say, large businesses and professional services firms?
There's quite a lot of information there, so I think of particular interest to those within the scope will be the 7 triggers that HMRC are proposing, which effectively are going to be used to identify what tax treatments are uncertain. So responses to this second consultation is due by the 1st of June, which is a pretty tight time frame, and I think it's aiming at allowing these draft legislative clauses to be published over the summer. And I think the second consultation sets out and seeks views on revised policy design, which takes into account responses received from the previous consultation. And I think these are expected to apply from April 2022. So again, it's worthwhile, as I mentioned before, making sure we're engaging HMRC on this front.
Yeah, so what's the policy objectives here and the scope of what that might be covering?
I think reading between the lines, I think it's aimed at helping reduce the legal interpretation portion of the tax gap, which is 4.9 billion, as noted in the 2020 report. I think HMRC believes the measure will enable them to, in their words, identify and clarify uncertainties other than they would have otherwise been identified businesses that are pushing the legal boundaries to create a level playing field. So I think the revisions made to the proposals are kind of aimed at balancing the objectives of speed and efficiency of intervention by HMRC, as well, along with the additional compliance burden that's going to be placed on large businesses with these measures.
Yeah, okay. And when you say the businesses, which businesses might be affected, and what would you say would be the changes from the initial consultation?
So I think, interestingly, on this front, there's no major changes to report on the businesses in scope. I think suggestions that entities that are signatories to the Banking Code of Practice should be excluded from the regime haven't been adopted. I think the government's of the view that it's not necessary to explicitly exclude those businesses, but there's no need to separately disclose arrangements subject to the code clearance.
Okay, and then just sort of following a similar theme to corporates versus partnerships, how might this affect partnerships?
So the second consultation has actually confirmed the government's intention that the notification requirement is going to apply to partnerships and LLPs that satisfy, again, the size criteria alongside corporates. So I think the size criteria is remaining unchanged, with businesses having turnover above 200 million or a gross balance sheet total above 2 billion to be within the scope of the measure. I think it's important to note that the second consultation is that not all the businesses within the scope of the measure have a HMRC customer compliance manager assigned to see their tax affairs. So it'll be interesting to see how HMRC tackles this point, because they've recognised that to ensure an equal treatment between these businesses, it's important that these businesses have an equivalent channel through which they can discuss any uncertainties and have a direct access to HMRC, so they're not required to make notifications. So again, I think it's going to be interesting to see how many of these businesses are within this category. Unsurprisingly, HMRC's consultation suggests there's very few, and what measures HMRC are going to actually put in place to level this playing field.
Yeah, and this point comes up a lot, doesn't it? That people don't have a sort of an opportunity to discuss certain things with HMRC because they don't have this person that they can always go to. What taxes are in scope on this?
So the tax in scope originally proposed to be modelled on the SAO regime, but it's now proposed that it's going to only cover corporation tax, income tax, and VAT. We can move on to the next slide, Jade. So I think the key areas for the consultation are the definition of uncertain tax treatment, threshold for notification, exclusions from the requirement to notify, and proposed penalty for non-compliance. I think the most significant concern with the original proposal was that the definition of uncertain tax treatment wasn't really clear, and a more objective definition was needed to enable taxpayers to assess whether or not they need to notify. So I think the second consultation is seeking to address this concern by proposing these 7 triggers for identifying whether a tax treatment is uncertain. And I think this is kind of one of the most critical aspects of the consultation. And this is where businesses will want to study and input the detail carefully. So some of the triggers, I think, will come to no surprise to those who deal with US and Australian notification regimes, focusing on treatments for which the accounting treatment recognises there's an uncertain tax position, where taxpayers adopt a position contrary to HMRC's known position per the guidance. There are also a number of additional triggers which widen the scope of the measure. I think of particular note is there's a trigger based on whether there is a new or novel product, a transaction or business structure where there's various ways that it can be treated by HMRC and the position is not known. There's also a potentially contentious trigger based on having received conflicting or unsupportive advice, with the risk that the regime kind of disincentivizes taxpayers from seeking objective advice or taking account of a range of views. So I think the the consultation acknowledges that transfer pricing also remains difficult. And I think it's inviting comments on the appropriateness of each of the proposed 7 triggers, which should determine when transfer pricing positions are uncertain. I don't think it's surprising that the timing of the consultation on the TP documentation is in line with this consultation. And I think we'll want to consider carefully the combined effect of both of these measures. Mm-hmm. And I think kind of what was noted there's an important change in this consultation, which I think can be welcomed by businesses, and that's the proposed increase in the de minimis threshold, which was 1 million to 5 million, applying consistently across all 3 taxes in scope, and is actually based on the tax amount. So to identify this, I think a two-stage test is proposed, which is looking first at determining if the total tax impact of the tax treatment is 5 million or above, and then secondly, whether the biggest tax difference between the taxpayer's treatment and HMRC's expected treatment is more than the 5 million tax threshold. So it's quite a large figure. I think where HMRC's position is unknown, or the taxpayer is unable to calculate the difference between their position and HMRC's, then step 1 is the valid test. So I think that's it on tax day. I think, as we mentioned, it's important for businesses and advisors to engage in the consultation. And I think, again, just to watch this space to see what comes up in the coming months. Next slide, please, Jace. Just conscious of time. So perhaps if we just briefly summarise, obviously Jitendra talked around the budget. If we maybe just quickly talk around what was predicted versus what may come into fruition in the future. Kicking off with kind of business taxes. Obviously, as Jitendra mentioned, I think there was rumours that the Treasury were considering a rise in CT rates. Those were generally higher than anticipated at the 25% mark. Might not seem very supportive of struggling businesses, but I think taxes will need to be raised to cut the deficit. It doesn't necessarily directly hurt loss-making businesses or small businesses, and I don't think it's going to have an immediate impact on consumer spending.
Yeah, and then Louis, on that dividend tax rate is always an interesting question. As Jitendra mentioned about the extraction of profits from corporates, whether it's service companies or from a corporate group. Any views on that?
Well, I think we've previously seen where there's been a rise of CT rate, there's been a corresponding adjustment to the dividend tax rate. So I think it'd be interesting to see if anything is done this time, given the fact that it's relatively expensive to now pay CT and then take a dividend out, and if this is going to be lowered in the future. It's not been announced, so I don't think we should necessarily expect a cut in such rates. So I think we'll have to wait and see, I think is the point.
Yeah.
I guess just following on the business point, I think it's noted that boosting business investment was quite high on the Chancellor's agenda. So the increase around capital allowances were expected, albeit the super deduction was kind of a relative surprise and an interesting announcement, I think. Just quickly moving on to employers, I think across the board cuts to NIC would have been popular after the pandemic, but they're pretty expensive. So unsurprisingly, no reductions were announced. There's always been ongoing murmurings around aligning self-employed NIC to employers NIC, but again, I think that's quite difficult to implement, so nothing announced again on that point. I think throughout the pandemic, Chancellor announced direct grant and support schemes to boost the employment of younger workers, being the age group most likely to have lost their job. And again, as we discussed earlier, the incentives for hiring apprenticeships between 1st of April 21 and 30th of September 21 has doubled to 3,000. So that's kind of helping get people in that age group into work, I think. Quickly on property taxes, I think SDLT cut for the residential property sales has proved successful in boosting the property market. No surprise to see that extended, I don't think.
Yep, and SDLT, any news on that?
Yeah, I think kind of there's always been rumours that the Treasury is considering replacing the SDLT altogether, as well as council tax, and replacing that with a new annual property value tax. I think this would have triggered difficulties and disputes over property valuation, so it's not surprising this has been parked for now. With one spokesman reported to have been saying, we've got no plans to introduce a new form of an annual property tax. So nothing in the short distant future at the moment. So that, again, we'll watch this space.
Yeah, very tricky.
And then finally, just personal taxes. I think there's an idea of a one-off wealth tax, similar to what Germany's done for years to kind of help the Treasury with money. But this was previously ruled out by the Chancellor, so no surprise that wasn't seen. There was thoughts there might be possible changes to existing wealth taxes. In particular, I think speculation that the rate of CGT would rise. I think that's boosted by the fact that the Office of Tax Simplification has recommended equalising CGT rates with income tax rates. I think that would have probably more than doubled rates for some business owners looking to sell out. So there's no increase in rates in the budget. CGT annual exemption was frozen, as Tendra mentioned, so I think we'll just have to wait and see in the future if there's any announcement on rate increases. And just finally, I think cutting pensions tax relief's always been touted as a way of raising tax revenue, and it's been suggested by commentators before most recent budgets. Each time the Chancellors refused to act. This budget could have provided an opportunity given how stretched the finances are, but I think again there was no announcements on this, so we just have to wait and see. So I think that's it for me. So back to you, Anna.
Yeah, brilliant, Louis. Thank you very much. And that whole point around pensions and providing for the future, and it's everything is very tricky, isn't it, from a policy perspective, no matter which way you go with this. Just picking up on one particular question, probably got time for one at the end here, and that's to you, Louis.
Right.
And this is in relation to the payment of income tax. So this is the timing of payment of income tax. So what would you think might happen here in relation to that?
I think it's hard to say, isn't it? I think kind of it's a very interesting point that's going to have the majority of taxpayers interested to see what action might be taken. I think it shows that, together with confirmation that the government's legislating to extend making tax digital to income tax from April 23, it's aiming to move towards their ambition of pretty much real-time collection of income tax, as well as corporation tax for small companies through a digital system. I think the consultations initially focused upon income tax and NI contributions for self-employed individuals, but in time may be extended to cover more timely payment of capital gains tax by individuals as well. And I think for small companies, it's going to include corporation tax on total profits, including any capital gains. I think it's going to be subject to corporation tax. So I think it's an interesting point. It's going to be followed closely as to what's going to happen.
Yeah, particularly within partnerships as well, with the complexities of different basis periods and
yes,
everything else that comes with that. No, it's fantastic. Right, I think we'll probably leave it there, and want to say very much, many thanks to our two speakers. So Chandra Patel, Director in the team, and also Louis Keeping, Associate Director in the team. So thank you both very much for speaking. We will send the recording to those attending in the next couple of days. But if you do have any questions on anything that we've raised today, or anything further that you'd like us to cover in topics going forward, please do let us know. We're designing these webinars around our audience. So as I say, please let us know what you'd be interested in hearing, and we'd look to design something around that. So thank you all very much for listening, and again to speakers and to everybody else who organised the webinar. Thank you very much.